Good morning. I'd like to extend a very, very warm welcome to you all and, of course, to our panelists for our discussion today. Inside Private Credit, hosted by the Global Institute of Credit Professionals, that's the GICP. We're very, very grateful to have you join us today, especially on what might be a choppy day or so for financial markets. So we really do appreciate the time for this discussion on the state of play and the evolving landscape of private credit. My name's Philip Waddy-Love. I'm a member of the full-time faculty here at Fitch Learning, which produce or provide the Global Institute of Credit Professionals. And I'm delighted to be joined today by our panelists, Megan Neenan, Winnie Cesar, and Zach Griffiths, who bring a wealth of expertise to our discussion. Megan is a managing director at Fitch Ratings and is the North American head of non-bank financial institutions. Megan's extensive experience covers a wide range of financial institutions, and her insights into the private credit landscape are truly invaluable to us all here at Fitch. Winnie is the global head of strategy, at CreditSights, with over 15 years in banking and research. Winnie is a leading voice in corporate credit strategy, frequently appearing on major financial news networks. She is an important voice in strategy setting for institutional investors worldwide. Zach is an economist and senior strategist at CreditSights. He brings a wealth of experience in macro strategy, rates, and credit analysis, again, regularly appearing on Bloomberg, CNBC, as well as in print with the Wall Street Journal and the Financial Times. So we're very, very fortunate to have such a knowledgeable panel with us today. We'll be covering a range of topics, from defining the private credit universe, examining recent market evolution, and ultimately discussing the potential risk considerations and maybe the future outlook for the asset class. We'll kick off today with 45 minutes of focused Q&A with our panel, and we'll reserve the last 10 to 15 minutes for live Q&A, so that's an opportunity for you to submit your questions, to pitch your questions to our panel here. So without further ado, let's dive into our discussion. And Zach, I would like to start with you. I'd like to start by exploring a definition of private credit as an asset class. What does it include, and what do people usually talk about when they refer to private credit?
Thanks, Philip, and thank you all for listening in. I'm looking forward to a great discussion today. When people are talking about private credit, I think they're normally referring to direct lending. And so that's really where a large asset manager with a committed pool of capital from its large institutional investors make a loan, either individually or in a small group, to a company. And these companies are typically private equity portfolio companies. And when I think about our LevFin Insights colleagues, they kind of group them in an under $25 million EBITDA is the lower middle market, 25 to 50 is the traditional middle market, and above 50 to 75 is kind of the upper middle market. If you get above that, which I think is certainly in the private credit space, that's kind of rivaling more of the BSL, the broadly syndicated loan market historically. And so those are the borrowers, and effectively the asset manager plays the role of a bank without having to go through the longer syndication process of finding other banks, going through terms with the borrower. And so typically the size of the loans in the private credit space are larger than a single bank would want to own or want to do on its own for a variety of reasons, including regulatory capital reasons. And so I'd say, just to put some high-level numbers around the size of the private credit market, I actually referred to Megan's piece for an update on this. Preqin puts private credit at around 1.6 trillion globally. Direct lending makes up about half of that. And when we think about the U.S. market, which is what Winnie and I have focused most of our effort on, it's about, call it 60 to maybe 2/3% of the overall market. And so I'd say the most common structure is the closed-end fund, which is a general partner, limited partner structure. That's really where you have these large institutional investors with 7 to 10-year capital commitments, highly illiquid investments, but these investors don't need liquidity. And I think that's really the bread and butter of how private credit got started. That's starting to morph a bit, and I know that we'll get into that in a little bit more detail. And so the last point I want to make about the size of the market, and perhaps why we're talking about it today, is the amount of growth we've had. And so just looking at the U.S. direct lending market alone, we estimated that it had risen about 3x in the U.S. since 2019, so about a 35% annualized rate. Compare that to the high yield bond market and the broadly syndicated leveraged loan market that had grown just about 3 to 4% annualized over that time period. And so thinking about this 1.6 trillion level, where are we going from here? Again, referring to Megan's report, Preqin estimates that we could be at 2.9 trillion for the global market in 2029, which is another 11% in annualized terms from here. So those are some high level stats to get the discussion going, Philip. Hopefully that caters well to where we can go from here.
Yeah, no, very, very helpful context. And some of those top line numbers are very, very arresting. Certainly when you sort of put it in the context, or you sort of compare it to, the relative size of the, the high yield market, broadly syndicated loans, emerging as a real competitive threat to those markets. Megan, I'd like to turn to you now. In your role as the North American head of non-bank financial institutions for Fitch, you've obviously seen what the investors look like in the private credit market. Could you highlight for us some of the key players and why they've been increasing exposure to this particular asset class?
Sure, happy to do that. And thanks for having me here. And Zach, thanks for the plug on our report. Appreciate that. The alternative investment managers are definitely the biggest players in this space. So that is the Blackstones, Apollos, KKRs, and on and on. So we do rate a lot of those firms. And so definitely have been tracking kind of what they've been doing. There's a variety of reasons why they've grown so quickly. But if you go back to the global financial crisis in 2007, there was a lot of regulation on the banks coming out of that, leverage loan guidance in particular, which limited kind of what the banks could do. And so the alternative investment managers saw an opportunity to kind of step in and fill the void. And since then, there's been a variety of different reasons why they've been able to grow even more quickly. And so there's certainly been lots of rounds of regulation, as we've seen, bank failures and other things. Banks have been in and out of the market with getting hung with deals at certain periods of time. The low rate environment certainly attracted more investors to the space. So it gave the alt managers an opportunity to really create some more product because they had the capital to deploy there. And so I think what we've seen is that the alt manager capital has actually been increasingly durable and more durable than what we've seen from the banks. And so that has gotten investors and sponsors more comfortable transacting with the alt managers because they know that they're going to be there. And there's been some emerging benefits of working with them in terms of privacy, certainty of close, certainty of pricing. If there are issues with the credit, you can kind of work those things out on a more bilateral basis than having to deal with a full syndicate. If we look at Blackstone, for example, their credit segment at the end of 2006 was $8.5 billion. And at the end of 2024, their credit and insurance segment was $234 billion. So significant growth. And that's something that we've seen really across the space. I think we'll talk a little bit later about how retail investors are kind of getting increasingly involved in the sector. But from an institutional investor perspective, as Zach talked about, they've been in the space for quite some time. And you're seeing them increase, their exposure. And I think just to highlight insurance companies in particular. So you're seeing alt managers, in some cases, own insurance companies outright or take minority stakes, but certainly partnering with them in different forms and fashion. And so creating rated product for insurance companies who can then, not have to hold as much capital against some of those investments if they're investment grade rated. And so we're seeing insurance really be a big driver of the capital availability to alt managers in the space. And that's certainly fueling growth. And Zach talked a little about the different areas. And as Preqin, focuses on growth from here, 2.9 trillion, and even the 1.6 trillion number, we think that might even understate kind of what's really going on because asset-based finance is really going to be, I think, what's growing and driving more of the growth from here in the space.
Okay, yeah, very interesting. Sort of expanding the types of credit that's available, maybe sort of even towards fund finance and things like that. You did made a really, really good point around what is fueling growth, what is fueling demand for this paper. How do you think about the recent move to provide retail investors with access to private credit? Would you say that this is a good thing for the asset class and the financial system more broadly?
Well, it definitely gives the alt managers more capital to work with, for sure. I think it's interesting. I like aging myself a little bit here, but we've been covering these vehicles called business development companies since 2005 at Fitch. And so they have been a big participant in the direct lending space. BDCs have actually been around since the 1980s. And so they were created in order to give retail investors access to the private markets. And so retail investors have been part of this market in some form or fashion, actually, for a long period of time, although it's certainly grown significantly. So BDCs had significant growth coming out of the GFC, but really started more massive growth in January of 2021 when Blackstone introduced a new kind of structure called the perpetual private structure within the BDC world. So these are BDCs and structures that are never expected to publicly list. They're distributed through the wirehouses, RIAs, and so the only way that investors can get liquidity out is through redemption. So they'll tender on a quarterly basis, and those tenders are capped at 5% on a quarterly basis. So Blackstone actually launched the structure itself in 2015 when they created Blackstone REIT, BREIT. And so that is an interesting kind of test. The CRE market has obviously had some challenges with rates. And so BREIT actually saw some increase in tenders for a few years. They're kind of only more recently getting to the point where tenders are below what the redemption terms or the caps are. And so that's just an interesting, I think, new wrapper that we're seeing. And so I think retail investors, there's now a question, I think, just about suitability, right? So do retail investors understand what they're getting into? If they're investing in a public BDC, they can sell the stock whenever they want, right? They can have access to liquidity pretty immediately. In some of these perpetual private structures, they can't get their money out overnight, right? So they're capped at 5% on a quarterly basis. So I think from a suitability perspective, that's just something we need to be considering, and obviously advisors need to be considering as they're educating the market on those products and what the constraints could be. I think from a financial system perspective, it's a good thing that there's caps, and I think that's the big issue. Is that if we go back to the GFC and you think about what kind of led to some of the issues that stemmed from the mortgage crisis, is valuation volatility, forced selling of assets. And you don't see that so much, or we wouldn't expect to see that so much with these current structures. A lot of direct lending still, to Zach's point, is in drawdown structures, permanent capital vehicles like the BDCs, and even these new perpetual structures, you're still capped at 5% a quarter in terms of redemptions, and the manager can still put down gates. So there shouldn't be massive forced selling of assets. I would caveat that by saying we're kind of in the early stages in some ways, right? There's still going to be continued development of structures. And so whether or not that changes, I think, is something we need to be kind of keenly focused on and keep an eye on. We're also seeing beyond seeing real estate and direct lending in these vehicles, we're now seeing private equity, infrastructure, secondary. Some of those have different redemption terms. So it is critical for investors to think about, what those terms are before investing in those types of products, for sure.
Very good. Yeah. Suitability, particularly for retail investors. But that's a really, really good point. And that sort of leads me into my next question, which was around providing liquidity to markets. So maybe Zach, could you talk a little bit about the role that private credit played in providing liquidity in 2022 when public markets were extremely volatile?
Yeah, I think the 2022 to 2023 timeframe is a great case study in how private credit can be a liquidity buffer to markets when you're really matching investors and borrowers with very similar timeframes. And I think that's punctuated by what we saw in March 2023 when we found out that there could be a pretty significant asset liability mismatch for these banks that are subject to runs on deposits. And I think the assumed duration of those bank liabilities, deposits, were much shorter than people had previously thought of. And so I think that's really one of the core benefits of private credit. I feel like over the past couple of years in my role at CreditSights, all the focus has been on, is private credit the rapidly growing unknown risk to financial stability? And I think up to this point, it's been just the opposite. When you had a backdrop in 2022 and 2023 of the Fed raising rates in the most aggressive way since the 1970s, we started hiking at 75 basis point clips in June of 2022. You had very volatile macro markets, which leave the public markets in a tenuous space, kind of almost regardless, maybe not for the very highest quality borrowers, but regardless of the financial and operational standing of these companies. And so private credit matched investors and borrowers really well in that landscape. And I think, to Megan's point earlier, some of the benefits to borrowers are this certainty to close, certainty of pricing. The private credit ecosystem is better set to tailor the covenants and the structure of the loan to specific borrowers so that you don't have to go out and get, dozens of banks' approval on certain terms. There's more of this relationship lending aspect to private credit, which is almost more like your typical commercial banking. And so while we were getting asked, what's the big risk? Is there a big risk to the banking system? We sort of saw it more as a liquidity buffer, at least over that time frame. Now, once some of these facilities have to get rolled, we still have higher rates. I think we're going to get into that maybe in terms of the market backdrop in a little bit more detail later on. Maybe things look a little different, especially if the economy softens dramatically. And so I think you had a situation where private credit has been able to offer illiquidity premiums to these longer term focused investors. Our analysis showed that private credit has returned 365 basis points more than the BSL market and 230 basis points more than the high yield bond market over the past 20 years or so. So there definitely is a benefit to not only the borrowers, but the investors. And when we go through our colleagues and Levfin Insights data they cover when direct lending facilities or private credit has taken out what were previously broadly syndicated loan facilities and vice versa. And that really bears out what we're talking about here. The data shows that in 2022 and 2023 as a whole, there were 57 direct lending takeouts of what had been previously broadly syndicated financing, and that compares to just 20 BSL takeouts. And so it works both directions. It's not a one-way street. But since then, the broadly syndicated loan market has gotten more competitive, and we've seen 90 broadly syndicated loan takeouts of previously private credit deals in 2024. That being said, there were still 50 private credit takeouts. And so I think overall, up to this point, it's been a liquidity buffer to markets, especially when things are volatile, and for maybe these companies that are in less sound financial standing, say, than the investment grade corporate market. It really brought together a good asset liability and perhaps risk return match in the market that could have been otherwise difficult to go through the public market venues.
Yes, it certainly seems as though that sort of inbuilt duration matching with a lot of these structures is a real help for both borrowers and investors as well. I'd like to turn to Winnie actually on that point between this sort of, I don't know if it's an uneasy relationship between private and public credit, broadly syndicated loan market. What are your thoughts?
Yeah, I do think that it is a bit of an uneasy relationship, as a lot of the flows into private credit have been perceived as competition to the public markets, high yield bonds, and broadly syndicated loans specifically. In fact, the high yield market has basically been the incredible shrinking asset class now for quite some time, where there's just not a lot of natural new deal flow going into high yield. Whereas the broadly syndicated loan space was really where a lot of private equity was focused in the, call it 2017 to present type period. And then private credit is kind of a natural extension of that. I would say that while there's some friction there is that broader perception that it's good that private credit was around to kind of step up and absorb some transactions that needed to get done in the 2022 and 2023 timeframe. And in general, we do continue to see this strong overlap between the worlds of public and private credit. And I think that sometimes the relationship is becoming even blurrier in some cases. This is especially true when we think about investment grade private credit. It's one where a lot of clients are telling us it's an area of rapid expansion. Even some IG corporate bond deals seem to be more clubby than truly syndicated, as they've historically been. And the investment grade private credit space definitely differs from leveraged finance. You see much more a focus on kind of project financing and expansion into more structured type vehicles. But that's definitely an emerging trend as we see this push for infrastructure building and especially data centers in the US. On the LevFin side of things, the dual track process definitely seems to be kind of the name of the game, especially for kind of issuers in that sweet spot of size that could go into BSL or could go private credit. It seems that this year, as Zach was saying, in 2024, there's kind of an extension of the scales being tipped in favor of the broadly syndicated loan market. Pricing is very tight overall. To start the year, we had really strong demand from CLOs and loan ETFs. I would say in March, though, that began to shift a little bit. And so I think that there is some apprehension around where the flow is going to go for the remainder of the year, just given that there has been a little bit of a pickup in broader market volatility. But this year, we've seen another 17 billion of broadly syndicated loan takeouts, so taking out private credit loans, whereas there's been about 6 billion going the other way out of BSL and into private credit. And so that ratio of about 2.9 times is actually the highest in the data series. So clearly, the scales have been kind of skewed toward the BSL market, and that is almost entirely a pricing play, right? Like issuers are looking at it and saying, wow, we can really save some serious interest expense by going through the headache of, a syndication process and getting public ratings. And then also on the private credit side of things, there are still some very appealing things in that you have this potential for a delayed draw structure or a PIK option. PIK became very, very popular in private credit over the past few years, with a lot of deals just picking right out of the gate, which always feels a little bit suspicious to me, but that has definitely become something that we observe more and more frequently. And as volatility perhaps stays with us, today is Liberation Day in the US. We'll see how that tariff announcement goes down. But historically, when you see more volatility, you have a bit of a delayed reaction in private credit pricing. So you could have a significant move wider in the high yield market, in the broadly syndicated loan market, that then is not necessarily seen in the private credit market. And that will ultimately just push more deals back into private credit overall.
Very good. Yes, absolutely. I would like to switch gears slightly. And Megan, I've got a question for you now around the very opaque nature of the market. Finding aggregated information on credit quality and defaults, it can be quite difficult. So I understand you've got a lens into some of the data, given your coverage of particularly BDCs and Fitch's middle market portfolio. What are some of the recent trends that you've observed, and where do you think credit fundamentals for private credit might go this year?
Yeah, it's true. The BDCs are definitely a more transparent corner of the market for sure. So they largely file SEC with the SEC, so they have Qs and Ks and 8Ks and things like that. And so on a quarterly basis, they have what they call a schedule of investments in their disclosure. So they list every investment that they have in the portfolio. You can see the spread, the maturity, what industry it's in, and then they have to fair value their portfolio on a quarterly basis. You can see the cost basis of the investment and the fair value. You can also now see whether or not there's a PIK feature or not in the pricing. And so that has been super helpful in terms of being able to track some of the trends. So I mean, Zach at the beginning talked about 1.6 trillion according to Preqin of private credit, 800 billion is direct lending, and BDCs are about $400 billion of assets. So a very, very big part of the direct lending space within private credit. So in terms of things that we've been seeing, I mean, it is competitive out there, as Winnie has talked about. So the M&A environment being relatively weak, and I think everybody's still kind of waiting for when that is going to pick back up, and the can keeps getting kicked down the road. Now people are talking about maybe second half of this year. And so you are seeing certainly some changes. And spread compression was a theme last year for sure, and PIK as well. So PIK at origination is something that is a big part of what we're seeing, and that is a competitive advantage relative to the broadly syndicated market. So I think we've seen that being used as a way to lure some capital away from the broadly syndicated market at times. For the BDCs, PIK as a percentage of their interest and dividend income was about 8% for 2024 for the 30 BDCs that we rate. So that's the average. It was 4% prior to the pandemic. So we certainly saw PIK increase meaningfully during the pandemic. A lot of that was amendment related. And that amendment-related PIK has come down significantly as we've come out of the pandemic. And now what you're seeing is structured PIK is what it's called. So it's structured at origination. And so our concern there is that to the extent that there is some dislocation, that exercising of PIK toggles, there's correlation in that, right? And so a lot of people decide to do it at the same time. And BDCs have to pay out 90% of their earnings on an annual basis, cash earnings, in cash, and PIK is a non-cash component of their earnings, but they still have to pay out, PIK revenue, right? It still counts as part of taxable income. So there's a potential mismatch there that we're kind of focused on. And then just from a credit perspective, I think the theme really has been differentiation. So we've seen a lot more differentiation in terms of credit performance across the portfolios over the last 18 months. I think on average, net realized losses in BDC portfolios was about 1.2% in 2024. So still, relatively low, but up from 0.5% in 2023. But the band or the range is 6.1% of losses to 1.2% of gains, as some BDCs have some equity exposure in their books as well. So a lot more differentiation there. Non-accruals is the same. You can see non-accruals range from 0% to 6.5% at the end of 2024. So we do think, the BDCs that are affiliated with the broader platforms, they have workout capabilities that might be a little bit more significant than what you see at some of the smaller franchises. I think that's a competitive advantage. And there's always the question of just access to deal flow, especially in an environment like today. You see some BDCs who have incumbency, which means they can kind of grow along with some of the investments in their portfolio, or they can proactively try to refinance and to make sure that the broadly syndicated market can steal some of those deals away. So you see some BDCs going on offense in an environment like today. And obviously that's leading to some spread compression. So a lot going on in the space. We have a negative sector outlook for BDCs in 2025 because of all of this and the fact that rates are staying elevated. And the economic backdrop is certainly more challenging than it was. We are expecting to see more losses this year for sure relative to last year.
Okay, so maybe some liquidity challenges to manage at the fund level. Winnie, how does Megan's outlook for private credit compare with high yield bond and the broadly syndicated loan market? Any better or any worse?
Yeah, so I would say that when we think about kind of the spectrum of leverage finance, high yield bonds look a bit more like investment grade light at this point, and then BSL, and then private credit. And we've seen that kind of domino of default cycles as well, where high yield went through a little bit of an uptick in a default cycle over the past couple of years. There was definitely this kind of contingent of what people refer to as zombie issuers that were just kind of in these capital structures that didn't necessarily make sense given perhaps some operational challenges or industries of secular decline. And then that kind of shifted into the BSL market, where BSL defaults have started to rise. I think as issuers have begun to realize, oh no, rates are not actually coming down at any meaningful pace in the foreseeable future. And while in the BSL market, it's oftentimes more difficult to default because of covenant-light structures and because there's a lot of private equity-backed companies, there's been a lot of liquidity injection into some of these portfolio companies. But I think that now that we've had, 2+ years of elevated rates and not a lot of optimism around rates going much lower, there's definitely more scrutiny on, okay, what are we actually going to continue to try to extend, or what just needs to go through some sort of restructuring cycle. And now it also seems like private credit defaults are starting to rise. I mean, the number that you see quoted in a range of different publications can be, as low as 1%, as high as 10%, depending on the portfolio that people are looking at and how they define defaults. There are a lot of really interesting nuances in looking at that. I would say right now in the US high yield market, the fundamentals are in pretty good shape overall. As of the last quarter of 2024, net leverage for high yield in aggregate continued to decline. Triple C's actually posted the most improvement as cash balances increased, which is definitely good. High yield interest coverage levels have definitely come down from the pretty lofty levels that we saw in 2021 and 2022, but they're still above long-term historic median levels. The market's really benefited from that lack of net new issue supply and have locked in lower rates from pre and during COVID. And then the broadly syndicated loan market was a little bit different. They had a much trickier challenge navigating the Fed's rate hiking cycle. Base rates increased so very quickly that really put some challenges into interest coverage levels in a market that was already on a bit less solid ground fundamentally, given that there's so much more sponsor activity in the BSL market, a lot more LBOs, a lot more M&A, a lot more dividend recaps than in high yield. And I think repercussions of this relative dynamic are continuing to materialize, with BSL defaults actually outpacing those of the high yield market, which is traditionally not how that works, and expected to remain a bit elevated, especially compared to high yield over the next at least year or so. So a lot of moving pieces there, and it seems like high yield bonds are kind of dislocating in a positive way fundamentally from the rest of the leveraged finance space.
Okay, yes, very interesting. One of the themes that we've drawn out over the course of the first questions really is we're sort of grappling with this idea of systemic risk. So staying with you, Winnie, we've seen discussions about a bubble emerging in private credit, posing a systemic risk to the financial system. How do you think about the criteria for systemic risk versus non-systemic? And why does the differentiation matter?
Yeah, great question. So I actually started my career in investment banking the day that Lehman filed for bankruptcy. So I think the concept of systemic risk was always kind of top of mind, even when I didn't realize what was going on around me, which I don't think many of us knew in September of 2008. I think that when we think about systemic risk, there needs to be a level of interconnectedness, and that creates some significant exposure across the financial system or the broader macroeconomy. Now, typically the big focus is the banking system and something happening to completely freeze up the flow of liquidity to where liquidity should always flow. So, the higher rated, more credit-worthy parts of the market. Of course, 2008 or the Great Recession is the kind of classic example of systemic risk in our lifetime. But the late 1990s dot-com bubble, Euro sovereign debt crisis are also some examples of systemic bust-ups. Now, these situations really differ from the US energy crisis that started at the end of 2014, lasted through 2020. The energy sector was definitely a large part of the corporate credit markets of the US economy. But the challenges that the sector faced in the default cycle within energy had more of an isolated impact. There were downgrades, there were defaults, but it didn't really spread that widely across the economy. And in fact, it really benefited consumers when energy prices were falling so significantly. I think that the Fed is a really interesting part of kind of the systemic risk definition. They've been very involved in trying to define features of systemic risk, things like domino effects from a failure of one institution, those kind of negative feedback loops or vicious cycles. Seeing selling and lower asset prices and then more selling, and it just kind of spirals. Disruptions to core market functions. If there's this drop off in liquidity, if an IG company can't come to market and get a deal done, that's usually an instance where systemic risk is at least something that we should consider. I think that market pundits and probably strategists like myself, we're always looking for that next bubble. What's going to be big enough and interconnected enough to put the whole financial system at risk? In 2023, we got a taste of this during the regional banks crisis, which at the time raised a lot of questions around systemic risk. Is this Bear Stearns 2.0 versus idiosyncratic risk? Are these just poorly managed institutions? And regulators and government officials also from time to time highlight concerns about asset bubbles and systemic risk. Oftentimes there are markets or sectors that are identified as posing a systemic threat. I think that the CLO market is oftentimes kind of brought up as one of those problematic places as well, but it hasn't necessarily actually materialized in any key way. And I think that the differentiation between systemic and idiosyncratic risk really matters for portfolio construction. If there's something truly systemic, the only place to hide is cash. There's really nowhere else to go. And then also the duration of the crisis. If you have an idiosyncratic sell-off like regional banks, the market can snap back very, very quickly, whereas systemic crises usually by definition take a much longer time to unfold and resolve, unless there's a swift intervention from governments and regulators. So while March 2020, with the onset of COVID, was systemic, we had such a swift intervention and significant intervention from the Fed, from pretty much every government across the globe, that it didn't really feel systemic at the time. Whereas 2008, it seems like there was a bit more of a delayed response, and that made the systemic nature of the 2008 challenges, I think, even more significant.
Yeah, very good. Now, we can't touch on systemic risk without asking Megan for her thoughts. You and your team put together a very comprehensive overview of private credit and noted that the asset class was not yet a systemic risk. In fact, that was in the title of your paper. What were the main factors that drew you to that conclusion?
Yeah, we figured using those words in the title would draw some attention to the report. But I think, no, I mean, I think it's something we get a question all the time. And I think it really is related to a lot of the things that kind of Winnie talked about. But I think in terms of just the asset class itself, right, the assets that are involved in private credit really are things that have been people have been doing for a long time. And some of it is things that have been done in the banking sector for a long time and have just moved to the non-bank sector. So in large part are asset classes that are well understood: corporate cash flow loans, asset-based loans like consumer assets, mortgages, fleet, things like that. There's certainly some esoteric asset classes like music royalties that you can see emerging, but whether or not those products are scalable, they're not really. I mean, how many Elvises are there kind of out there to be able to securitize those royalty streams on? So I think that's giving us some comfort on it, and also just the structure. So Zach started off saying lots of permanent capital, drawdown structures here, not needing to kind of force sell assets. And I think when you have to force sell assets, that leads to valuation implications potentially for other asset classes and liquidity crunches across the sector potentially as well. So I think we feel comfortable that those things don't exist today, but it is a sector that is continuing to evolve. And generally when that happens and competition increases, you start to see people start to reach and do some different things from a structure perspective that could potentially lead to some more concerns. I would also say, when you mentioned the banking sector, and certainly regulators are focused on getting more information and granularity around bank exposure to the private credit space. And so with December 31st call reports, they were requiring banks to increase their disclosures. They used to have a 1-line item in the call report that is now expanded to 5 in terms of trying to get some more granularity around that exposure. Everyone has to be in compliance by the end of June 30th, but we got pretty good data coming out of December 31st. One of my colleagues in the bank team published a report on that. And generally, the bank exposure is deemed to be pretty modest to private credit today. And a lot of it is things like warehouses, which they've been doing for a really long period of time. Yes, they're extending revolving facilities to BDCs, for example, but they're top of the capital structure, right? There's a lot of collateral that they have held against those. And so the question is, are they better off, lending directly to those corporates, or are they better lending to a company that is lending to those corporates and you have the top of the capital structure with the collateral package? And so I think those are things that we're kind of thinking about as well as we think about the state of private credit today.
Yeah. So would you say that in terms of the other risk factors that you might be monitoring, that's quite high on the list? What other risk factors are you considering at the moment if it's as an asset class, this does not yet pose a systemic threat to the financial system?
Yeah, and I think when you mentioned the term too, interconnectedness, and that's something we're definitely focused on. So the alt managers are getting bigger and bigger. LPs have, consolidated their investments more and more with the biggest general partners in the world. And so those guys that have the most product diversity are certainly getting the lion's share of the assets under management. You see firms like Apollo and Brookfield talking about growth over the next 5 years, doubling of AUM. You already have Blackstone and Brookfield with over $1 trillion of assets under management. And you see Blackstone financing Carlyle deals and Carlyle financing Brookfield deals and on and on and on. So there is more interconnectedness for sure within the alt manager ecosystem. And so that is something to kind of keep an eye on. I think I also mentioned at the top of this just around insurance companies, right? So life insurers in particular, which are affiliated with alternative investment managers, they have 4 times as much level 3 assets in their investment portfolios than life insurers that are not affiliated with an alt manager. And those level 3 assets, what that means is there's not a market quote available generally on those assets. So they're deemed to be more illiquid. And so that's something that certainly insurance regulators are thinking about and monitoring. And then as you start to see more and more product creation for those life insurers, there is the question about ratings and potential rating shopping, right? So you have equity capital that you have to hold against those insurance assets, or those assets in the insurance company has to hold against their assets in the investment portfolio. And there's a better capital treatment if it's an investment grade. And so are you kind of looking around to see who can kind of give you the best rating on a different structure, different asset class? And so the NAIC, which is one of the regulatory agencies associated with the insurance companies, are kind of looking at challenge authorities around those ratings starting next year to kind of question and make sure that they understand the risks that the life insurance companies are taking on. So I think all of that is something we're very focused on, in addition to what I talked about with regard to the retail investments. You're seeing growth in interval funds as well, beyond just, what I talked about, the perpetually private structures. And you also recently have an ETF that's out there that has some private credit assets in it as well. And so there is some talk about development of a trading market for private credit assets. And to the extent that develops, how reliant are people on that over time, and how might that have some trickle effects potentially too, if it hasn't been tested through some kind of market disruption or economic cycle as well. So there is a lot to keep an eye on for sure in the space.
Yeah, very good. Zach, for you, public credit investors, how would you recommend thinking about the interplay between the outlook for rates, public credit, and private credit returns?
Yeah, I think there's a lot to consider. And just to dovetail off what Megan was saying, I did a presentation for the FDIC last year about private credit. They saw our primer series and wanted to have one of us come speak to their regulators that focus on the big banks. And at the time, I basically said, nothing looks too crazy. We're not seeing huge leverage in terms of how banks are exposed, at least to direct lending. It's really just these revolvers and term loans they make to the direct lending funds, which Megan was just talking about, and these subscription finance facilities, which are really secured by the capital commitments of the LPs. Those have been historically extremely safe, even in the financial crisis. So not a ton of banking system risk there. I think now adding on to interconnectedness, which was kind of what I identified as maybe the biggest concern, most difficult to really trace, is this potential for an introduction of an asset liability mismatch. I think it's a little strange that we're trying to start private credit ETFs when illiquidity is kind of one of the key cruxes of private credit, and things have evolved. And I think Megan outlines really well how BDCs have been around for a long time, and those are liquid. They're publicly traded, at least in some instances. I know a lot of the recent growth has been this non-publicly traded. And so there are a lot of moving pieces. And I think that asset liability mismatch adding on top of interconnectedness, which seems like it might only be intensifying, is a big thing to consider. When you're considering public versus private markets, I think one of the big views that we had coming into this year is rates are likely to stay high for longer. Therefore, maybe adding some floating rate exposure to your portfolio makes sense, because fixed rate was susceptible to a repricing in terms of rates higher. And we kind of got that in January, but we've come back down quite a bit from here. And when we think about our scenarios, we're kind of increasing the probability of a bear case or recession scenario where the economy finally does roll over. I feel like this is something people were really concerned about at the end of 2022 going into 2023, yet we've had robust economic growth since then. And so we're not calling for a recession as our base case. We're kind of increasing the probability there, but maybe the idea of moving down the capital structure and having that floating rate exposure is a little bit less appealing based on what we've seen in terms of volatility in the markets, uncertainty in terms of fiscal policy, certainly on the trade front, and a variety of other fronts. And I think one of the big things that has supported markets over the past couple of years has been this idea that the Fed and other major central banks will definitely be cutting. Even just having that expectation was supportive of flows. And I think, that has shifted, at least for now. Maybe if we do get the recession, the Fed is chasing rates lower. But if you do have that, then I think fundamentals will deteriorate and you'll want to be up in quality and shorter in duration. So that's kind of how we're thinking about the market as a whole.
Yeah, some interesting regulatory implications potentially down the road. Thank you very much, Zach. I would like now to turn it over to you, the audience. This is an opportunity for you to pitch your questions to our panel. We'll do our best to get through as many of these as we can in the time that we've got remaining. It's your opportunity to tap into their expertise on any aspect of private credit that you might like to explore further. If there's a particular thought or comment that sparked a question, we've got some questions coming in already. So we'll take this one from the top. And I think the first one may be something that was sparked by a thought from Zach right at the beginning. it was around the 3 times growth of the asset class. How do you feel about this? Do you feel as though that the growth in the asset class is a function of low base effect, or what else might make the what else is it about the attractiveness of this market? So low base rates.
Yeah, that's a good question, and perhaps I should have been more explicit about that. So that was a 3x growth in U.S. direct lending from 2019 to 2023, and it is a much smaller base. I think it was about 165 billion in 2019 to call it just shy of 500 billion as of that data point. You compare that to leveraged loan and high yield bond markets, which are I think 1.3, 1.4 trillion, and so the point that I had made in this presentation to the FDIC in particular was, yeah, this is growing. It's becoming extremely popular. But if you especially look at the U.S. market and think about how big of a piece direct lending is in terms of not fixed income as a whole, but even the leveraged borrowing market, it's still relatively small. And so I think there's a lot of focus on it. It's become very popular. But when thinking about systemic risk, as Winnie went through, it's also important to put in context the absolute size. And so I think that's a big point, and I'm glad the question was asked to kind of clarify that growth has been rapid, but it's still not certainly the preponderance of where some of these lower rated companies are getting their financing.
Yeah, and related question, very good question from Natalie. Hypothetically, could we see a complete elimination of the public banking sector in certain asset classes? That's quite an interesting one. I don't know, Winnie, would you like to take that one?
I can hop in. So I think that this is an interesting one. We've definitely seen an elimination of lending to some industry groups on kind of a public basis. ESG, as it became very popular in called the late 2020s into the late 2019 into 2020 and 2021 timeframe, there is historically, public lending to a lot of energy related firms and gun makers and ammunition providers, and also some of the prison systems as well. And there became much more of a pushback on lending to those, both kind of in the banking system and within the public PSL market or the high yield bond market. But these industries haven't entirely gone away. Presumably they're still getting financing somewhere. It's just kind of out of the banking system overall. So I do think that there will continue to be these kind of trends where specific industry focuses are perhaps not as amenable to public banking sector credit and lending. But, to say something like all of the leveraged finance world is going to move out of the public sector and into the private sector, that seems a little bit more of a stretch to me. Never say never. Crazy things have happened in my career, and crazy things will continue to happen. But I think I see that as less of a risk versus specific sectors and industries kind of falling in and out of favor.
Yeah, so from my point of view, it's interesting to introduce some competitive tension to the broadly syndicated loan market, which is where I spent a lot of my career. An interesting question really around data. So from your experience, where do you see the biggest data gaps in credit markets today? What role do you think real-time consumer data can play in closing those? I guess that's a question for all of us, because both credit sites and Fitch Ratings are in the business of closing the information gap. Winnie, you're still off mic. Do you have some thoughts on that one?
Sure. I mean, I think that the biggest push and pull on the data side of things is on the kind of frequency of data, the real-time-ness of some things. And that can be macroeconomic, that can be trading data. Within the credit markets, there's been a lot of changes to provide much more real-time data in terms of valuations. The high yield bond market used to have the 144A cohort that was not trace eligible. So nobody knew where those bonds were trading, what the actual levels were. And broker-dealers were absolutely capitalizing on that and making some pretty solid money in trading high yield bonds. Now that changed within just over the past decade or so. Broadly syndicated loans now with the advent of electronic trading and BWICs and OWICs, you're definitely seeing a lot more real-time kind of high frequency data in terms of valuation levels. I guess on the private credit side, there is actually a question about default rates in private credit. That's a big part of the data conversation. Nobody really knows what the default rate is. I think also recovery rates are interesting because there's a lot of challenges around measuring recovery. Is it, trading prices the day after a bankruptcy filing? Is it ultimate recovery? There's a long time lag between a company filing for bankruptcy or going through a Chapter 11 restructuring and the ultimate, this is what everybody is going to get. Sometimes that takes years to decades. And so there's definitely a lot of challenges in terms of assessing what recovery rates are going to be. And then just on the macroeconomic front, everybody is trying to make sense of the hard data of jobs and inflation and the more soft data of consumer sentiment. And how do we make sense of where consumer sentiment has gone and is going and how that's actually going to influence the harder data, because the relationship really broke down in the 2022 timeframe, and that's been a big challenge. So I think overall, there are a lot of data gaps in the credit markets, which gives me better confidence that I will continue to have a job.
I don't know if Megan, you came off mute as well. I wondered if you had any sort of thoughts or things that you discovered through the process of your research on this, let's face it, fairly opaque asset class.
Yeah, I would just highlight, so our leveraged finance group actually does about 300 privately monitored ratings, and they also do credit opinions on CLOs, and that's about 900 names. So of those two kind of portfolios together, we have a default index. So the default rate, for example, on a trailing 12-month basis through February, I think was 5.7% on that portfolio, and that's up from 5% in the prior month. And then to Whitney's point, the question really is how you define default, right? So that can differ a little bit, particularly relative to the BDC. So they don't have the same kind of default concept. They have a non-accrual ratio that they publish, which is really subject to a lot of interpretation. And then ultimately they have realized losses that they record. But the big question is recoveries, to Whitney's point. So if there's a recapitalization, they will have to write off a portion of it as a realized loss, but ultimately they are still working that credit over time to get some recovery on that. And so I think there really isn't a true default rate, with a recovery adjusted, I would say, within the space, because I think actually the performance has been pretty good. And a lot of these BDCs in particular that are affiliated with the big alt managers, they aren't afraid to take the keys on these businesses and work them until they maximize recoveries. And so I think actually some of the data would be pretty good, but I think there would be, again, a lot of differentiation within the BDC space in particular on recoveries.
Okay. Just as a reminder to those of us that weren't able to join us this morning, one or two questions coming in regarding transcripts and replays. Yes, there will be replays available. This session is being recorded, so do feel free to pass these along. And in fact, we would encourage you to pass these along to your colleagues if they weren't able to make it. Another question here really this is on liquidity premium or illiquidity. Yeah, liquidity premium. Someone was asking, it was Christian, was asking what a proxy for liquidity premium there might be for private credit versus broadly syndicated loans. I guess this is the $64,000 question if you're in the business of structuring these things. Zach, what do you think? What have you discovered?
Yeah, so I mentioned that historically we've seen about 365 basis points more in terms of total return on private credit on average versus leveraged loans going back 20 years. So that's a pretty nice data set. If we just take the 2014 data, that had shrunk to about 215 basis points. And I think that's probably an oversimplification of the situation, but I do think it's probably fair to say spreads in general have compressed. And I think we all kind of went through some of the push and pull between the private and public markets looking to get these deals done, whether it be broadly syndicated loans taking out direct lending and vice versa. So there is some competition there that is shrinking spreads in general. Spreads have tightened in, at least up until recently, across a wide variety of asset classes. And so I think in terms of just using a benchmark, so that puts about 150 basis points less of spread compression than the long-term average in 2014. That feels directionally reasonable in terms of how to think about that, how the market's evolved, and how some of that spread pickup has kind of been shifted out as competition for these deals has increased.
Yeah, I just want to take the opportunity also to plug our colleagues on the Leverage Finance Insights team, which is our news reporting team, and they have amazing data around both broadly syndicated loan and private credit pricing. And just looking at recent private credit deals that have taken out broadly syndicated loan deals, the average is, a step up in interest expense of call it 50 to 100 basis points. So really not that much overall, and just kind of shows that issuers are willing to pay up a little bit for some of the positives of a direct lending deal versus a BSL deal. But, they're really not having to pay up that much, at least not recently.
All right. Thank you very much. And I think that's an opportune time for us to begin to wrap up. A couple of minutes left. I would like to draw attention to a couple of things before we wrap up. Firstly, a massive thank you to our panelists. Really insightful discussion, I thought, today. And it's a great opportunity for us to talk a little bit about the research that Fitch Ratings continues to do. As we've mentioned a couple of times on the call, Megan and her team recently published a very in-depth paper titled, Private Credit Growth to Continue, but Not Yet a Systemic Risk, which certainly offers some valuable insights into the growth of the asset class and its linkages with more traditional financing. Credit Sites offers a very comprehensive Private Credit 101, something I've certainly found very useful. And their Covenant Review and Leverage Finance Insight desks do provide research on in-market transactions, which cover pricing structure and some really interesting insights. I would say some market-leading insights into the documentary robustness of some of these private credit agreements. The last thing I'd like to do is to share my screen. This is something for those of us that are considering the GCC. So that is the qualification for the GICP, lots of acronyms. Global Credit Certificate. We have an opportunity for those of us that have yet to sign up for it to sign up. There is a discount available for April. The GCC is the GICP's flagship qualification program. So you can visit their website, www.gicp.org, or you can scan the QR code to register for more information. It's a professional qualification. There's a designation that goes with it and a skill set which can transform your career. So if you use the discount code SAVEGCC April at the checkout, it'll give you a 20% discount. Fitch Learning is also providing a one-day virtual course on private credit, covering some of the basics. So if you're interested in learning more about PIC structures, what they mean, how they're implemented, you can certainly join us for one of those courses. Do visit us at fitchlearning.com to register for those. Likewise, if you have any questions, please email us at institute@gicp.org. Thank you again to our panelists, and thank you all for your questions. I thought it was a great session, and I'll let you get on with the rest of your day.